Good evening, class, and welcome to our advanced taxation class for tonight. Today we are on capital allowances part 2. In part 1, we stopped at balancing charge. So we learned different kinds of capital allowances. We learned that there is something called initial allowance. There is something called investment allowance. Then there is annual allowance. And of course, there is rural investment allowance. And also balancing allowance and balancing charge. So these are the types of capital allowances that we have learned, and we're going to be using them extensively. Today, we are going to start from capital allowance rates and restrictions. Now, capital allowances are not just limited to one rate. There are several rates as long as there are several qualifying capital expenditure. Now, we know the rate for investment allowance is 10% on plant and machinery. That is standard. We know rural investment allowance. That one is non-negotiable. We have the acronym WET, and we said where there is no water, that is 50%. Where there is no electricity, that is 30% or so, and where there is no tarred road, there is 80%. So we have that. Then we know balancing allowance to be the difference between all the allowances you've claimed or the allowances you are supposed to claim if your asset is not being sold. As at when you sell them, the difference between the balancing, the tax written down value, and the proceeds that you got from your sales. So that one doesn't need too much calculation. Now, the thing is, initial allowance and annual allowances, how do we get them? So if you look at the rates here, the initial allowances are given first. The annual allowances are given next. You may not, because you are going to be given this rates in the exam. But you know, when you are familiarizing yourself with questions like this, these rates will automatically come easily. All right, let's look at the notes they gave here. In respect of qualifying expenditure on plant and machinery for the replacement of old ones, a one-off 95% capital allowance in the first stage shall be allowed. The 5% book value shall be retained until the final disposal of the asset, provided the aggregate capital allowance granted in respect of any asset shall not exceed 95%. Supposed to be for mining. Let's not bog ourselves down with this because we are going to be seeing action on that. So let's go down now with what is important here. Now, where double taxation relief is applicable, you will still get to see this when we are looking at double taxation relief. Paragraph 23 of Schedule 2 permits a company to elect that the initial or annual allowance due to it be calculated at a lesser rate than that which is normally applicable as summarized under capital allowances rate shown above. When such election is made, the less shall be the appropriate rate to be used to compute the amount of capital allowance due to the company for that year of assessment. For now, we're not concerning ourselves with that. The D part is where we shall concern ourselves now. Capital allowances to be deducted from assessable profits of company in any year are restricted to 66 to third. Now, the way they wrote it down here is not correct. Look at the way it should be written. This is 66 2 over 3%, not 662 over 3%. Because some people usually make this mistake to write it like this, 662 over 3%, 66 to third percent of such assessable profit. Now look at this thing, except for companies engaged in agro-allied industry and manufacturing companies. Now, this means that if your company is into agricultural business or is into manufacturing, you will not experience this restriction. What it means is this. If your capital allowances is, say, 1 million, and your assessable profit is, say, 1.2 million, you're not going to take the whole 1 million to remove it from your 1.2 million. You're not going to take the whole 1 million capital allowance to deduct from your 1.2 million assessable profit. No. You are going to look for 266 to third percent of assessable profit. I'm going to demonstrate that. Now, let's look at what I mean. Here they said capital allowance restriction. I will not say except for companies engaged in agro-allied and manufacturing. So only these two are not exempt. Now, the restriction is restricted to 66 to third percent of assessable profits. Now, what does this mean? Now, how do we convert 66 to third percent to something we can use mathematically? Now, let's look at it. 66 2 over 3%. Now, this is a mixed fraction. In our mathematics days, this is a mixed fraction. Mixed fraction. We want to change it to improper fraction. So what do? We will multiply. You will multiply this denominator 3 by 66. You say 3 times 66. That will give you 198. You will add this 2 to whatever you have. We'll now say plus 2. Now that is 200. So it is going to be 200 over 3. So this means this is 200 over 3. So this 66 2 over 3 is 200 over 3. Now notice we didn't touch this percent. So this percentage is still there. All we've just done is 66 2 over 3 change to 200 over 3%. Is still there. And we know that percent is over 100, right? So percent is over 100. So this means that it is as good as saying 200 over 3 over All right, so I'm going to take it again now. From here, we said 300, 200, and we say percent means over 100. So the 200 over 3 is the same 200 over 3 we have here. Now, in place of this percent, we put /100, which is over 100. Now, we are arranging it this way. 200 over 3 on the one hand, divided by 100. So it's still the same thing. Mathematically, we will not leave it as divide. We can convert it to 200 over 3. Now, when we change this divide to multiply, it becomes 1 over 100. Because normally this is 100 over 1, as it is. When you change this divide to times, it becomes 1 over 100. Now, an interesting thing happens. 0 and 0, we cancel 0 and 0. And so it becomes 2 over 3. So what am I trying to say? I am trying to say that 66 2 over 3%, that is with the percent. If you don't put the percent, you're not going to get it. 66 2 over 3% is the same thing as 2 over 3 without the percent. So which one is easy for you? To say 66 2 over 3% of accessible profits, you are correct. If you also say 2 over 3 of accessible profits, you are correct. If you say this 66 2 over 3 without this percent, you are not correct. Because without this percent, it's simply 200 over 3, which is wrong. That would mean that your answer you would have gotten would have been 100 times smaller than, bigger than the normal answer. So you have to put this percent to reduce it. So if you express it this way, you are correct. If you express it this way, you are correct. So in my class, I will be expressing it as 2 over 3 of accessible profit. If I express it this way, in my workings, you will use...
1 second, please, Chima.
Sorry?
Sorry, is this correct? Sorry, 200 over 3%. That's 200 over 3 divided by 100. We should be normally, it would be 200 over 3 times 100 over 1.
No,
Not
times 1 over 100.
No.
If you say 200 over 3 divided by 100, which is what
And
I
if
just
you're
did.
saying, yeah, if you're saying, I'm sorry, I'm not trying to, but if you're saying 200 over 3 divided by 100, if you're now bringing it times, the 100 is supposed to come on top and the 1 down. Not
No,
mathematically.
no. This is what is this. This is what this 200 over 3 divided by 100. 100 is 100 over 1. If you are changing this divide to multiply, 1 go up, 100 comes down.
No, but in the mathematical sense,
That is what I am doing. Mathematical sense is what I did here.
I'm not trying to contest. I'm not fighting here the way you are taking. I'm just saying, because I even used the calculator to even do 200 over 3% is wrong.
Okay, let's do it.
Mathematical sense.
Let's do it with calculator so that you will see.
Okay.
Let's do it with calculator so that we will see.
200 over 3.
Open a bracket. 200 divided by 3. Close the bracket. Then you say percent. Where is your percent? Let me change the... Okay, this is scientific, yes. Where's our percent? Our percent is not here.
Answer.
Let me use this. Okay, this is standard. Let me change. Let me go back to this scientific. There should be a percent here, which is not here. Okay, so another way is doing that is like this. Open a bracket, 200 divided by 3. You close the bracket and you say divided by 100. Now watch what the answer will be. 0.66666. Now let's look at this other one here. We have 2 divided by 3. It gives you the same thing. It gives you the same thing. This shows that what I did here is absolutely correct. When you are changing percentage, it goes under. When you say 200 divided by 3 divided by 100, you don't do it this way. If you do it 200 divided by 3 divided by 100 is wrong. Okay, it still got the same thing. But okay, it's still the same thing here. Still the same calculation. So you see, whichever way you do it, there's no way we can do 66 to third percent in this calculator. Otherwise, you will still see the same thing. You will still see the same thing. So either you use 2/3, which is what you will be seeing in most computations, then you are correct. Without the percentage, this without the percentage is not this. So you have to add the percentage for it to be this. All right, so let's see. Capital allowances are also restricted when there is a private use. So let's say we have your vehicle, motor vehicle, and you are using it partly for company use and partly for private use. What happens? Monday to Friday, you use it for official purposes. Saturday and Sunday, you use it for private business or private use. So you now need to prorate the capital allowances. So it means that in a week, 5 days out of 7 days is for business. The 2 days out of 7 is private use. So it's only going to be restricted to the time you are going to use it for business. The private use does not count. Also, basis period less than 12 months. When you are calculating basis period less than 12 months, you are going to prorate for the number of months in the basis period. That is where you see me doing something like M. That is where you see me doing something like M over 12, where M is the number of months in the basis period for that year, and 12 is the normal basis period in a year. Now, qualifying capital expenditure. Qualifying capital expenditure that qualifies for capital allowance in a basis period falls under these categories: plant, machinery, or fixtures. We have building structures or work of a permanent nature. Then we have mines, oil wells, and others. You might see this in mining tax. You might also see this in BPT. We have plantations, we have research and development, agricultural plants, transportation motor vehicles. That is fleet of buses of not less than 3 used for public transportation. And of course, we have public transportation, intercity, new mass transit coach of 25 seats and above, operated by a recognized corporate private establishment. Am I having question? Then we have
You're
development.
too fast.
Okay. All right. So why I was fast here, because these ones are not too important.
Okay.
Where I'll be deliberately slow and repetitive, these are the ones that are important.
Okay.
All right. So this building work.
Sorry, 1 second, please. In cases whereby you know that it's not really important and then maybe you have to be fast, maybe something we need to go back to read. Please, can you just highlight to just let us know that okay, this particular one, we are not dwelling on it, we can read it on our own so that we can note it down.
Okay.
Thank you.
So most of all these reading parts are not that important. Now, coming to buildings purchased, this is important. When you purchase a building, the relevant interest to the company making the purchase is the original cost of construction of the building or the price paid for it, whichever is lower. So when a building is purchased, you look at how much if you are making the purchase, you need to know how much was used in constructing the building, or how much are you paying now for it, whichever is lower. So, land in itself does not depreciate, it appreciates, but buildings depreciate. So if you check the original cost, it might be higher, but what you are paying now for it might be lower. Vice versa, the ones you are paying might be higher than the cost of construction. So you need to know which of them is lower. Now, if the building is purchased second-hand, no initial allowance can be claimed by the purchaser. So in the case of building bought second-hand, you will not claim initial allowance, but annual allowance can be claimed based on the amount of relevant interest as defined above. So you can be claiming annual allowance, but no initial allowance. This is because here, initial allowance is supposed to be claimed once. Now, when a building is purchased new and initial allowance has not been claimed, now the initial allowance will be claimed. Annual allowance will also be claimed. So the initial and annual allowance are claimable by reference to the relevant interest. That is the cost of construction by the original owner or the purchase price, whichever is lower. What it means here is, once you have identified either the construction price or the purchase price, whichever is lower, you take it as your cost. You will calculate your initial allowance based on that cost and your annual allowance based on it. If it is the construction cost that you choose, it's fine. If it is the purchase cost, it's fine. So you need to know that one first before you can now think about where to base your initial and annual allowance computation. So that's it. We'll be skipping these ones here. We'll now go to conditions for granting capital allowances. Capital allowances are granted if the following conditions are satisfied. Now, 1, the company claiming the allowance must be the owner of the asset at the end of its basis period. What it means is that at the end of the basis period, the asset will still be bearing the company's name, meaning that the company will not have sold it. It will not have sold it, because if you sell it, you will not be the owner. Secondly, you may be using an asset for your business, but you are renting it. You are not the owner. It may just be there's two types of lease, finance lease or operating lease. It might be an operating lease, and you may not be the owner, but you're using the asset. So because you're not the owner of the asset, you cannot claim capital allowance. But if you are the owner, as at the end of the basis period for the year, you claim the assets. So that's one. Number two, the asset must be used for the purpose of a trade or business carried on by the company. So it means that it is for business intent, not private use. So that's why you see that private use of an asset is being excluded, because capital allowances are only granted for business, for the purpose of making profit. If it is profit motive, then it's fine. You may be having houses where you are giving out for lets, and that's for business, for making money. But if you are living inside the house, that part you are living is not for profit making, there will be no capital allowance. So that's it. The part where you are not making any profits from or making business on will be excluded from capital allowance. So note that the ownership and usage should be on the last day of the basis period for a year. For this purpose, a period of temporary disuse is ignored. So it means that you may be using an asset and for some time you stop using it, or you start using it again. The thing is, if your business ends on 31st December, let's say for example, as at that date, are you still the owner of the assets? Then capital allowance should be used, claimed. Two, has it been used? Is it still in use by the company as at that date? Then that is a determinant. Now, also, when an asset has been acquired but has not been put into use at the end of the basis period, capital allowance can be claimed provided the first use to which the asset will be put after that date is the purpose of a trade or business or company. So what it means is that if it is not even put into first use as at the end of the year the asset was claimed, was bought, so far as it is going to be for the purpose of trade or business, then capital allowance can still be claimed. If eventually the asset is not put to such use, the FRS will raise an additional assessment to cancel the effect that you benefited by claiming the capital allowance. You know, the capital allowance is supposed to reduce your tax. So that part that you reduce and you didn't put it into use, they're going to, will I say, reinstate it and charge you tax on that. All right. The grant is for a year of assessment and is usually against the assessable profit of the basis period for that year. So what it means is that capital allowance for a year should match assessable profit for the same period. So it means matching concept is here. In the event of insufficiency of assessable profit to cover the claim for the capital allowance, after applicable restrictions, the unrelieved amount can be carried forward to future assessment years with no time limit. Now, let me demonstrate this for you. Let me demonstrate this for you. Okay, so let's say we have assessable profits of 1,200,000, right? Then we have capital allowance claimable. So when you've computed all your capital allowance, this is what you're supposed to claim. You are supposed to claim, let's say, 1,100,000. Okay. Now, if your company is a trading company. If your company is a trading company, what happens? Look at what happened. So you will say accessible profits, 1,200,000. Capital allowance claimable. Here it is 1,100,000. Okay. Now you cannot claim this whole 1,100,000 because this is not a trading, this is not an agri company, it's not a manufacturing company. What will it do? You will now look for restricted to restricted. Okay, this restricted is not pairing well. Restricted to 2/3 of accessible profits. So in that case now, you open your bracket, 2/3. This is more simpler than going to write 66 2/3% of accessible profits. So you say 2/3 times 1,200,000. But let's see what is going to be. So you have, let me shift the calculator to remove it from where to block. So, wow. I'll bring it back again. Okay, let it be here. 2 divided by 3 times 1,200,000. That will give you 800,000. So what you will now do there, this is 800,000. So this is the capital allowance that you can claim, the highest capital allowance you can claim. So what it means is that the capital allowance you can claim is the lower of what is claimable and the restricted. Restricted here means this is the highest you can go. The highest you can go here is 800. So if what you are bringing for claim is higher than 800, it's only 800 you can take. If what you are bringing is lower than 800, then it is what you are going to claim, that because this is the highest you can go. So now this is also what we put here. 800 is what you can claim out of this 1.2. So what it means here is that this is your taxable profits. The taxable profit is be 1,200,000 minus 800. That will give you 400. So it is 400,000 that will be assessed to tax. So it means out of 1.2 million that was supposed to go for tax, you have claimed 800,000 out of it to be exempt from tax as a tax relief by way of capital allowance. 400,000 will now go for tax purpose. Now, what will you do again? You know that you have 1.1 million here claimable. You have only taken 800. You have only claimed 800. What happened now is the remaining 300 is your capital allowance carried forward. So this 300, you are going to carry it forward to the next period. So it means that in the next period, when you are bringing your capital allowance, you will first bring, so carried forward here will become brought forward for the next period. You will now add whatever you have for that year to this to get your capital allowance claimable before you will now do your restricted. Now, this is for all companies. Now, the restriction only affects companies that are not exempt from it, which is agriculture and manufacturing. So, but in the case of manufacturing, so let's say this is manufacturing stroke agric business. Now, what do we do? This is our 2 naira sign. This is your accessible profits. Let's say this is 1,200,000. Capital allowance. Your capital allowance, you will not be thinking about restricted. All you just do here, you bring your 1,100,000. So it means that only 100,000 will be going for tax. So this is your taxable profits. There is no restriction here, no restriction to carry forward. Now, assuming that instead of 1,100,000, it was 1,300,000 or maybe 1,400,000. What happened here is, if it is 1,400,000, you can only claim 1,200,000 that your accessible profits can carry. It's just like saying that you are owing 1,200,000, or somebody, you are asking somebody to give you a loan of 1,200,000 or to give you a facility of 1,400,000. And he said, okay, no problem, I've had you. But what I have here is 1,200,000. What you will say is that, all right, give me the 1,200,000, let me take it first, while you are owing me 200,000. So it means that 200,000 will be carried forward next year. That is the point we are trying to make here. All right, so let's go back. Now, a claim should be made by the company before any capital allowance can be granted. So the capital allowance claim should be made by the company. However, if no claim is made, some allowances can be granted where the revenue service is of the opinion that it will be reasonable and just to do so. For example, when they give you a best of judgment assessment. Now, when we say best of judgment assessment, this is when you are not filing your tax. You didn't file your tax and the government waited until the due date, you didn't file. They will now say, okay, the due date has passed. We will look at what is obtainable in that industry. Let's say it's a tuition house. What is available in the tuition house industry? What are the capital allowance they can claim? What is the likely profit they are going to make? They will now use their own judgment, their best judgment, and say, okay, you made 25 million or maybe 27 million. This is the capital allowance you are claiming, 10 million. Now you're not the one who claim it, but the revenue office feel it is reasonable to allow that claim. But normally in the self-assessment regime, you are supposed to claim by doing your returns. and claiming what is claimable. Now, where a basis period for any year of assessment is a period less than 1 year, for example, when the commencement provisions are being applied, the annual allowance for that assessment year shall be proportionately reduced. That is the proration I'm talking about. The relief is granted by deduction from the remainder of the assessable profit in the computation of the company's total profit. The remainder of the assessable profit is the assessable profit plus any balancing charge, less any loss relief due. Now, what it means here is the principle of loss over capital allowance is played here. Loss over capital allowance. So what I mean is this. Look at what I mean. Let me give you a typical example now. All right, Madam Mercy, please, your hand is up. Can I hear your question?
Yeah, sorry, sir. I just wanted to ask if you were still sharing your screen, because I can't see it.
You can't see the screen? Okay, let me
Yeah.
stop sharing and start again sharing the screen. Okay, so, wow. Thank you for that feedback. Let me share my screen again. Please, at any point that you are having difficulty of anything, kindly bring it to my attention. So please confirm if you can see my screen now.
Yes, I can. Thank you very much, sir.
Very good. Now, I want to illustrate this loss over capital allowance. Let me write it here. Loss over capital allowance. Now, let me write it here. Now, it means that you must claim loss first. So it means loss is claimed first before capital allowance. Loss is a relief. By the time we are going to be learning loss relief, you are going to know more about it. But now we are talking about it, you will see it now. So let's say you have assessable profit. Let's say your assessable profit here is 1.2 million. Then we now bring in, okay, let's say this is 1.5 million. Let's say this is 1.5 million. You will now have to less loss relief. Now the loss relief comes first. So let's say your loss is 300,000. You have to remove the 300,000. And when you less it, this will be 1.2. This is also called assessable profit. Now, when you want to claim your capital allowance, let's say your capital allowance is 1 million. Then you will now do restricted to 2/3 of assessable profit. Now the 2/3 of assessable profit, which of them are you using? You are going to use this. So I'll come here accessible profit 1. This accessible profit 2. It's going to be accessible profit 2 when you are doing capital allowance, because the loss has taken this and it is resulting in this. So the accessible profit 2 is what we use. So if you look at it now, it's going to be 2/3 times 1,200,000. We've calculated it before to be 800,000. So look at the capital allowances you have for the year. Look at what you are being restricted. So what it means that this is what you are going to use because it's lower, 800,000. Okay, so it means here that 400,000 is your taxable.
400.
Is it 200? Sorry, it's 400, yes. Now, in the case of your capital allowance that you are going to carry forward, you have 1,800,000 is now being claimed. 200 is capital allowance carried forward. So you see here, loss comes first before capital allowance. Now, another thing I should tell you is if you are doing your education tax, I will have to state it here, although we are not learning education tax. Education tax is TET, and we say is 2.5% of accessible profit. Which of these two should be accessible profit? 1. Should be the first accessible profit. That is where you are basing your tertiary education tax. But your capital allowance, 2/3 of accessible profit should be on 2. This is the point I want to state here. We're not going to calculate tertiary education tax here now, but we are just stating here that the loss, the relief granted by deduction of the remainder of accessible profits in the computation of the company's total profit, which I call taxable profit. The remainder of the accessible profit is the accessible profit plus any balancing charge, less any loss relief due. So you have to less the loss relief for you to know the accessible profits to use.
Sorry, I have a question. What if we have loss relief, tertiary tax, and capital allowance? Which one would come first amongst the 3?
First.
Okay.
Like in case we have the 3.
Yes.
Oh,
In case
yeah.
we have the 3,
Yeah.
loss comes first after
Okay.
you've stated your accessible profits.
Yeah.
The next thing you are checking is loss.
Okay.
So loss, then you check capital allowance. The next is tax.
No.
LDT. Tertiary education tax is still a tax.
Okay. But I thought you said that in terms of tertiary education and capital allowance, we deduct tertiary education first. That's what you just said earlier.
No, that's not what I said. I said the 2.5% of accessible profit is calculated on this. That doesn't mean that that is what you are going to calculate first.
Wait, sorry, I'm confused here. You said 2.5 would be on accessible profit 1.
Yes, I'm
That
telling you where you are basing your calculation of accessible of tertiary education tax is going to be based on this.
on the
On this accessible profit. Why your capital allowance is going to be, your restriction is going to be based on this. That doesn't mean that you're going to calculate TET first. That doesn't mean you're going to calculate TET first. TET is a tax. Taxes are calculated last. But when we mention accessible profit for TET, what we mean is this first one.
Okay.
When we mention accessible profit for capital allowance, what we mean is this. But where there is no loss relief, there will be no 1 and 2. Both of them will be calculated on the same base.
You don't do capital, you don't less capital allowance when you are doing TET.
I didn't get that.
So basically, when we are checking for tertiary tax, we don't deduct capital allowance. You do it
Leave the
on
tax, leave the
base.
tertiary education tax now. I will show you how it is being done. I just brought it out here as an aside to show you that it is from this side that we are calculating. Is this a base? It means we are calculating 2.5% of this. That is the reason why I brought that.
Okay.
Just leave the tertiary education tax. I will show you how the format is going to go so that when we are solving, you will see it.
Okay.
All right, so where a relief is, okay, unutilized capital allowance in the year of permanent cessation of or trade carried on by a company. So now it means that if you are on cessation year, and you have unutilized capital allowance, what it means is that after you have calculated your capital allowance and you do your restriction and you have capital allowance to be carried forward to the next year. That means your capital allowance carried forward, as in this case that we had here, capital allowance carried forward in this case, 200. This is unutilized. So I'll write it down here. This is unutilized for the year. So in case we have unutilized capital allowance in the year of permanent cessation, all right, of a trade or business carried out by a company, this shall be available for relief against the remainder of its assessable profit for the preceding year of assessment, and so on, proceeding up to 5th year before the year of permanent cessation. What this simply means is this. Assuming that we have year of assessment, this is 2020, 2021, 2022, 2023, 2024, 2025. And this is the year of cessation. Now, if we have unutilized capital allowance, like as I showed you, we cannot carry it to 2026 because the business has ceased. The business is not in existence. So there is no need going to 2026 because this is the going concern has ended. What it now means is that instead of saying capital allowance carried forward, it will change to capital allowance carried backward. Capital allowance carried backward. So it will go here, it will go backward for the first year before. If it is still not unclaimed, it will go backward again for the second year, go backward again, third year, go backward again, fourth year, go backward again, fifth year. Now, at this point, this is the last point, last stop. Now, if it is not fully claimed, say if not fully claimed, it will be forfeited. So let's say out of that 200,000, you've been carrying it backward and backward, and all that is left is maybe 10,000 that you cannot claim after 2020. You cannot carry anything to 2019 because that will be carrying it 6 years above. But the law says it must stop 5 years after the year of cessation. So this becomes 1, 2, 3, 4, 5. So you are counting backward 5 years. If after these 5 years you cannot claim it, the remainder that you cannot claim is fully lost forever, is forfeited. That is what that restriction is saying. So, yeah, so this is what we just said. Then the next one is where a relief is to be granted to a company after the assessment has become final and conclusive in the respect of a year of any assessment year. The revenue service may make such repayment or set off the tax or any part of such tax paid or charged for that year as may be appropriate in lieu of making the deduction for the amount. So it means that here, after the assessment has become final and conclusive, meaning that
Number one. Number two, I'm calling you on
somebody is talking.
family.
I can't hear you. Is this for this class?
I'm calling you from first family.
Your voice is sounding far away. I can't hear that. All right, so I've muted everybody. So if you want to mute. Where a company is granted assessment and it has become final and conclusive, then the revenue realize that, oh, they are supposed to grant you a relief. They are going to refund you that amount, or they are going to reduce it. They are going to make a set off. So they can tell you that, okay, take it to the next year, set it off as against your total profits for next year. Or they can give you a refund for that amount. It's just like, let's say you paid more than your subscription, and your balance is showing negative in your financial status. ICANN will say, okay, set it off as against next year's subscription. But let's say you paid over in your exemption. Maybe you are granting exemption and you're supposed to pay maybe 130,000 and you now pay 136,000. You paid 136,000, maybe that's what they told you to pay. Then they now found out it's supposed to be 130,000. What they will do is that they are going to refund you your 6,000 excess, or they will tell you that, all right, that 6,000 naira, take it to offset your subscription. Or let's say it is even induction you are paying for, and you have cleared your subscription. They might give you the 6,000 naira as your balance, overpaid, or they might tell you that, okay, in your membership subscription, you are going to use it to offset it. That is what they are trying to say here. So when it needs to be offset, they can refund you if they want. Now, the residue of expenditure is the total qualifying capital expenditure incurred less the total of any initial and annual allowance granted to date. investment allowance should not be deducted from this. What they are telling you here is residue is what we call net book value in financial accounting. Net book value in financial accounting. But in tax language, we call it tax written down value. That is a residue of your expenditure. How is it being calculated? It is calculated as the cost of the qualifying capital expenditure minus initial allowance minus your annual allowance. Note here that investment allowance is never deducted from cost to form your tax written down value. That is what we are saying. So when we say the residue, we mean the tax written down value. Now, in the year of permanent cessation of a trade, when an asset is disposed, balancing adjustment will need to be made. Balancing allowance will be granted when the proceeds of the disposal or the value on the date of cessation is less than the residue of qualifying capital expenditure. What it means here is balancing allowance is equal to tax written down value minus cash. Now, so this balancing allowance, where TWDV is greater than your cash. So you see, when the proceeds is less than the residue, this cash is the proceed, is less than the residue of the tax written down value. But a balancing charge will now be cash minus tax written down value, where the cash is greater than this tax written down value. And is limited to the capital allowances previously given. All right. Now, there is no, somebody saying something. Can I hear you clearly?
Yes, sorry. Are you still going to give us this formula, or are you going to take it again because it seems to be
Which
fast?
formula? You'll be seeing it in workings. They don't give you this formula. They're only explaining it here. There's nowhere it is being.
Please can you take that part again because you were quite very fast and I'm also taking
Was I
notes.
fast?
Yeah.
Okay.
No, just that part. I mean,
I want to take it down here.
okay, thank you.
This is your tax written down value, and you have 1 million naira. What it means is that if you are continuing the asset, if you didn't sell the asset, or if your business is still continuing, the company will claim this 1 million in the long run. But you now sold the assets and your cash proceed happened to be 700,000. It means you have lost. Normally, the government is saying in the long run they are giving you 1 million, but you have gotten 700. So what it means is that tax written down value is greater than your cash proceed. So it means balancing allowance will be tax written down value minus cash, which is going to be 300. It means that you've collected 700, right? Government is going to give you additional 300 as balancing allowance so that it could meet up to this tax written down value. But in the case where your cash proceed happen to be 1,200,000, you have collected more than what the government is going to give you. So this 200 is going to be an additional income for you. So it become balancing charge is going to be cash minus tax written down value, which is 200. This is because your cash is greater than your tax written down value. Now this 200 is a balancing charge that you will need to charge tax on. That is what they are saying here. All right. There is no difference in the meaning of disposed of and value of an asset as contained in CETA. So this is just semantics. So when they tell you disposed of and value of an asset, they say there is no difference in meaning. Now, the amount of capital allowances calculated is generally restricted to a percentage. At present, 66. So now they are spaced 66.2/3% of accessible profits. Any company in the agro-allied industry or that which is engaged in manufacturing is now affected by this restriction. A company that is agro-allied is a company carrying on agricultural trade or business. So these are the definition of agricultural trade. So that's it. So what we have basically seen now is we've seen restriction on capital allowances. We've seen how capital allowances rates are the initial allowance rate, annual allowance rate, restriction, which is 66.2/3%, which we have mathematically deduced it to just 2/3 without the percentage. All right. Then we've seen that a manufacturing company or an agricultural business does not have this restriction. And we saw capital allowance being carried backward when unutilized as at the cessation date. Instead of carrying it forward because there is no business anymore, you carried it backward. From the year before cessation, you count 5 years. And if after that, it is still, you have remnants that have still not been claimed, that remnant is forfeited. Then now we have calculation on capital allowance on assets acquired on hire purchase. Okay, so what I would do now is, I don't want us to dwell too much on all of this because it's going to scatter what we've learned. So we are going to end capital allowance discussion here. Part 3 we start on this because this is a whole set of calculation and understanding on its own. So I will say part 2 ends here. What we are going to do now is to see if we have any question that relates to what we have done. Let's see if there's any question that relates to what we've done. This is page 128. Let's see if there's any question here. Oh, we can even go ahead and do this, but I don't want us to go ahead and do this. We'll do it in part 3 and we'll still calculate some other things. So if you look at it, there is carried back of capital allowance. So, but let's stop that so far and do some calculation. Now, this question number 1 is not going to be solved because it relates to part 3 that we are going to do because this is hire purchase. We're going to leave that. Question number 2, we are going to do question number 2. Okay, no, we'll leave question number 2 for next class. Question number 3. This one is asking you for explaining the conditions for granting capital allowance. It's in our notes. Question number 4. ATAX Limited incurred qualifying capital expenditure of 2 million on furniture and fittings in 2020 assessment year, when the revenue of the company is 24 million. The company achieved a revenue of 27 million in 2023 assessment year. Now they say compute the capital allowance claimable for all relevant years. Okay, so look at what we are going to do now. Question number 4, ATAX Limited. So that's what we are going to do. Wow. That's what we are going to do. So this is illustration number 4. ATAX Limited. Okay, so let's look at ATAX Limited again. It incurred qualifying capital expenditure for 2,000 on furniture and fittings in 2020. So we'll say qualifying capital expenditure is furniture and fittings. Year of, I don't want to put YOA, year of acquisition, year of acquisition. So that if I put YOA, it will look as year of assessment. No, year of acquisition. Let's see what it said here. 2020 year of assessment. 2020 year of assessment. Now we are assuming, because they didn't tell us the date it was bought, and they didn't tell us where their year end is. We are assuming this was bought in the beginning of the year. That is one assumption we are making. Because they didn't tell us the date it was bought, they didn't tell us the date where they are making their accounts up to. If they have told us that, we would have said, okay, let's prorate from the date to the account year end. They didn't tell us that. And so we are safe to assume that it was bought in the beginning of the year. Now they said revenue at year of assessment 2020 is how many? 24 million. 24 million. Of course, you know, when the revenue is 24 million, there will be no tax. Now, we now say year of assessment 2023 revenue is 27 million. revenue is 27 million. What have I done? I've brought down every items of the question. What are we asked to do? Compute capital allowances claimable for all relevant years. So relevant years is, they gave you 2020, year of assessment. Wow, somebody is doing annotation. 2020 to 2023. These are your relevant years. So what do we do now? We'll start. Year of assessment, 2020. We'll say costs. How much is the cost of the assets? 24, no. Are we giving the cost? 2 million. 2 million. How come I didn't write it? Let me write it here. Cost of assets, 2 million. Okay, so let me write it down here again. The cost of the assets is 2 million. You know, it's furniture and fittings. Then the next thing will be to less initial allowance. What is your initial allowance? Initial allowance. So I'll do something here. What's your initial allowance? In capital allowances rate, we'll come back to this place. This is page 131. Let's go up to where we saw that rate. So that we'll all right. We have furniture and fittings. So we have initial allowance is 25%, annual allowance is 20%. So initial allowance is 25%. So what we'll do here is 0.25, which is 25% of 2 million. We'll calculate it now. $0.25 multiplied by 2 million. That will give you 500,000. So this is 500,000. This is your initial allowance. I'm going to still put it down here again. 500,000. But this time around, I'm going to minus it. Why am I minusing it? This is because I have to remove initial allowance from your cost to get what is going to be claimable as annual allowance. So this will be 2 million minus 500,000 will give me 1,500,000. Right? Now, less annual allowance, we say is 20%. So it's going to be 0.2 multiplied by 1.5. 1.5 million. Of course, 1.5 million is the difference between cost and initial allowance, right? So what do we do again? So 1.5 million multiplied by 0.2. That will give you 300,000. I'm going to write 300,000 here. I'm going to put 300,000 here. So what am I going to do now? I'm going to close the brackets here. Okay. So what it means here is, which should I calculate first? I will calculate this first. 500 plus 300 gives me 800,000. This is your capital allowance for this year. You've claimed 500 initial, 300 annual, 800 claimed for the year. Okay, so you come here, year of assessment 2021. You will start with, instead of starting with costs, we didn't buy another asset in 2021. It is that same asset, but what happened? You will start with tax written down value. And what is it going to be? It's going to be 1.5 you have here minus 300, which is 1,200,000. That is your tax written down value. You know how we got our 1.5? We remove 500 from 2 million, got 1.5. We remove 300 from 1.5, we got 1.2. Now, in this year now, we are not going to claim initial allowance anymore. We're only going to claim annual allowance. Now, our annual allowance will still be the same thing we calculated here. We will never go and do 20% of 1.2. No. If you do it that way, it means you are doing reducing balancing method. That is not the way. The way is straight line. And straight line is this. It's either you do 0.25 of 1 million, or you simply say 1.5 million divided by 5 years. Divided by 5 years. How did we get the 5 years? Our 5 years was gotten as a result of, let me do it here. Our 5 years was gotten as a result of 100% all over 20%. Of course, the percent will cancel the percent. 100 divided by 20 gives me 5. That is how we got the 5 years. 1.5 million divided by 5 is 3. So it's the same thing we are going to do here. Either you use 0.2 times 1.5, or you repeat your 1.5 million divided by 5 years. Because it's straight line. So it means that what you use here is what you are going to consistently use. The only time that you will not use the same thing is if you prorate the first year. If you prorate the first year, you will redo it in the second year like this and use it that same way. So 300,000 is your capital allowance for the second year. You are going to bring it down here again. 300,000 is your capital allowance for the second year. So your year of assessment 2022, you also go with tax written down value, which is going to be 900. 900. Okay. So once again, you are going to less annual allowance of 300, which we are going to also less it. $300 capital allowance. I apologize for my network. I got a call that disconnected me. Sharing my screen again. All right. So your 2023 year of assessment, tax written down value is 600. Your annual allowance is the same place. All right. Now the question the question says relevant year of assessment. I want to make it up to 2024. It is not relevant in this question, but I'm going to look at it and show you something. Year of assessment 2024. Now notice here,
Mr. Chima,
I have your attention. Can you say what you want to say?
are you saying the annual allowance will be the same thing for that
That is
second year? It will be the
annual
same.
allowance. Is what is being charged every year.
It will be the same thing.
It's the same thing.
Okay.
When they say something is straight line, if you are doing straight line
Yeah,
depreciation,
it will be
it's
the
the same
same
figure.
thing.
That is what
Yeah,
I mean.
yeah.
Allowance is straight line. The
Okay.
same thing.
Okay.
Same thing. The only time you are going to get different thing is in the first year. If your
Yeah.
first year is not full 12 months, you prorate only the first year. Assuming
Okay.
that the is maybe 8 months in the first year, you will say 300,000 times 8/12.
Okay.
The year 2 will still be 300, no proration. Year
Okay.
3, 300, no proration. Now, I want to show you something here. So, we said this is 5 years, right? So, this is the first year. This is the second year. This is the third year. This is the fourth year. Now, look at the last year, year 5. This is the last year you can claim annual allowance. So, your tax written down value is 300,000, right? Yes, your tax written down value is 300. Now, less annual allowance. Your annual allowance, we usually say it is how much? 300. Now, watch. If we do it here, 300, it means this is 0. It means your tax written down value is 0. Now, in tax, we should not have a 0 tax written down value. Never, never, never ever have a 0 tax written down value if the asset is still in your possession. A 0 tax written down value means the asset has been sold. If the asset is still in use and not sold, never ever have 0 as your tax written down value. It means that you should have 10 naira. Some company do 1,000, but it's 10 naira. So it means that this figure should be 10 naira less. This figure should be 10 naira less. So what I would do here is your annual allowance will be 300,000 less 10 naira, which is 299,990. That is what your annual allowance will be for just that year. 299,990. So this 10 naira means you have finished claiming the assets. The only time you remove this 10 naira is when you sell the assets. And if you sell the assets more than 10 naira, of course, you know you're having a balancing charge because your assets, the proceed will be bigger than the 10 naira. But when the asset is still in use, never, ever, ever sell it. Never put 10 naira, never put 0. If you decide to sell it at 10 naira, fine. If you decide to sell it at free, you claim your 10 naira when you are selling the assets. So now your annual allowance is going to be 299,990. That is the only time again your annual allowance will not be the same as 300. In the first year, if you have less than 12 months, and in the final year of claim, that is 2 times. So let's see what I can say is their solution. The page here is 131. Let's see what they said here. Question number 4. All those ones we jumped before, we are going to do them in our next class. So you see, it's still the same thing, the way we did it, 10 naira retained in the books. So look at what they said here. In the year 2020, they have a cost. Look at the initial allowance. Look at the annual allowance, 800,000, right? Now, you cannot utilize this 800 because your revenue is less than 25 million. You will be carrying it forward. We are not asked to calculate tax. That's why we didn't do that. This 800 will be carried forward. Now we have annual allowance in 2021, which is 300 as we calculate, right? Then they didn't do it the way we did our own. Now they're adding this 300 to this 800. It means 1.1 million is your total capital allowance that you have from 2020, 2021 when you are not utilizing. In 2022, you have another 300,000, making the total capital allowance to be 1,400,000 not utilized. Right? Now, in 2023, what happened? Look at what they did here now. All your unutilized capital allowance, they removed them and they got 600 to get your tax written down value. It's the same thing. It's technically the same thing we did. And we got our 600. It's technically the same thing we did. Then this is your tax written down value. This is your annual allowance of 300. And you remove 300 and you get 300 here. Then 2024, 299,990. 10 naira is retained in the book. They said, given the fact that the company did not achieve 25 million naira revenue until 2023 assessment year, it will be regarded as a small company. And the initial allowance of 500,000 and add-on allowance of 300, which we said here, 1.5 times 20%, which is what is used for the whole year. This is the calculation. Will be deemed unutilized in these 3 years because their revenue was not up to 25 million. You cannot even claim the capital allowance, but you'll be carrying them forward. The tax written down value of the qualifying capital expenditure will be brought to 2024 year of assessment. And the 2.2 million naira less all of these capital allowance will be equal to 600,000, like we said. Then the capital allowance claimable for 2023 year of assessment is 300, while that of 2024. So what they meant here, it's not 2024, it's 2023. It's a typo. While that of 2024 is 299,990. We have a retention of 10 naira in the books. All right, so that's as far as we can go for capital allowances for today.
Sorry,
You know,
I have a question. If we do it the same way we've just done it with you, it's okay, right?
yes,
Okay.
as long as you understand my explanation is the same way. The two of them is the same thing. The two of them is the same thing. So what we are going to do now is, by our next class, when we look at the hire purchase, which is the one that is remaining, we will now solve some questions in the study pack and also do a carry back of capital allowances. We will see how, so there are two things we have not done. We are going to do the hire purchase and the carry back. We will illustrate them with examples from the study pack. Then we'll see how we will use past questions to illustrate all that we have done. So in this case now, our knowledge of commencement rule, cessation rule, change of accounting date, and capital allowances will be consolidated together. So thank you so much for honoring today's class. It has been a fruitful one, an eventful one. I hope to see you in the next class when we will start part 3. Let me just make this notification here. Let's see. Part 3 starts here. So that's where our class is going to start from next time. So until next time, this is saying goodbye, and please revise the recording when it is gotten to you. Thank you so much. Any questions so far, you can ask me later in the WhatsApp group if there is any. Otherwise, it's good night from me.
Good night.